Hi, Tom Lydon with ETF Trends here in Hollywood, Florida at the Inside ETF conference. I'm here with David Braun, portfolio manager at PIMCO. Great seeing you, David.
Thank you for having me, Tom.
So surprisingly, more people were talking about the threat on the fixed income side than maybe the equity markets being long in the tooth here at this conference. What's the average advisor need to think about as you look forward in your fixed income portfolio?
Great question, Tom. So what we've seen is a massive amount of flow into passive strategies, largely benchmarked to the Barclays Aggregate. What we've been advising our clients on is, it's not your grandfather's Barclays Ag. So we put out a paper recently that talked about lots of changes in the Ag. So if you look at it before the crisis, it was 4.2 years of duration. Now it's over 6 years of duration. That might not be that bad if you were getting an extra yield for that, but you're actually getting a lot less yield. Before the crisis, you were getting about 5% yield, now you're getting 270 if you're lucky. So we think a lot of people have been in the bond market in passive products, they've done well, but now that we think that rates are on the move, the economy's healing, inflation is potentially on the move, we think folks really need to revisit active management.
Yeah, and also the credit quality in the ag has slipped a little bit as well. Do you think that most advisors that are benchmarking to the ag just committed to that at one point in time, but haven't kept up with the way it's changed?
Yeah, interesting observation. So when we look at the corporate component of Barclays Ag, that's probably the one that has us most concerned about people not paying attention to what's going on there. First of all, you're delegating all of your credit underwriting to the rating agencies, right? So you're not doing any of your own credit homework. If they say it's BBB minus and belongs in the ag, you buy it. Second, you're allocating your capital based on the market cap of these issuers. So whoever's issued more and more debt, you buy more and more of that debt. I always use the analogy to our clients, if you're running a local bank, would your credit criteria be how much debt you have outstanding when someone walks in the door asking for a loan? And then if they have a lot, you give them a big loan. If they don't have a lot, you give them no loan. It's kind of the opposite way of the way I would do it if I ran a bank.
Right.
And then the final thing I'll say about the credit component is, if you look at the BBB component that's in the Barclays Ag, so just the corporate component, it's almost 50% now. It used to be in the low 30s before the crisis. So you've got a bigger basket of credits that are lower quality, and you're lending more and more money to them.
Okay, so the first thing is understand what you're investing in. Maybe a lot of advisors haven't looked under the hood regarding the ag lately. Second, regarding active, talk about that and let's get into the weeds a little bit. What are things that you would do from an active standpoint now that maybe is not reflective in the ag?
Yeah, so first of all, we put out a paper last year called Bonds Are Different, which does an empirical study of the data in active bond management. We found that on average over 10 years, active bond managers are beating their passive peers, unlike in the equity world, by at least 50 basis points a year. And in an environment where you're only getting 260, 270 on the Barclays Ag, that extra 50 basis points is meaningful. So the way we're running bond, the PIMCO active bond ETF, is we don't feel tethered to a benchmark.
Yeah.
We have a more comprehensive toolkit than the assets that are in the benchmark. We're trying to build a more diversified portfolio than the benchmark that out-yields it, currently out-yielding by almost 100 basis points, and that we think is of similar quality and provide the same diversification benefits should there be a downturn in the markets.
Absolutely. Well, what would the number one thing be that you're excited about when you look to manage bond in 2018?
Just the uncertainty and question marks that are in the broader economy, right? So we've got a Fed that's lifting off of zero quite successfully so far. We've got a fiscal stimulus from Washington. 9 years into the economic expansion, you're throwing a fiscal stimulus on this, right? So you could argue, we're growing at our potential, labor markets are at full capacity, now you've got fiscal stimulus. This could, in our mind, we wrote about this, could create some overshoots on the interest rate side, on the inflation side, and at minimum, some extra volatility in the bond market, yeah, which we think will be perfect for active managers like ourselves.
It sounds like you're excited.
Very excited.
Great. Well, thanks for stopping by. I'm a big fan of PIMCO and BOND.
Yeah.
Look forward to seeing more.
We appreciate that. Thanks for having me.
Take care.